Should we be concerned about what's going on in the bonds markets right now? High yield risk on was risk off for the first time in a little while. Meanwhile, the reverse repo market from the Fed dropped to a new low of $440 billion. And the dull market continues with a series of 2 steps up and 1 step back. Today, we'll talk about the key levels that you need to be watching for the markets moving forward, where the opportunities lie, and whether you're possibly using moving averages a little bit wrong. A top tip coming up as we cover stocks, commodities, and cryptos together in today's show. Well, welcome back everybody to The Daily Show. My name is Tom, and today we're discussing the latest macro, lead indicators, and the hottest charts together. Remember to subscribe and hit that bell icon if you love markets like we do, and we'll get started with the stocks and what was going on there before covering commodities and cryptos. So really, what was it? It was yields up across the board, and that led us into the high growth stocks, the semiconductors, and the energy and the metals. And this is where we've been seeing most of the movement from Wall Street recently. And of course, hopefully you've been following a bit of it because it's been quite nice. Semiconductors, gold, metals, communications. If we go over to the last 5 days though, you can see it really has been about gold, metals, energy, utilities as well. And it's been really like that for the last 1 month, ever since Nvidia dropped around 20% in literally a week. So why is all of this? Well, a lot of it has to do with this problem, and it's the problem of higher for longer yields. We're getting some economic data that's coming out that's kind of bullish, and we're also getting the Fed saying, oh, we're probably going to cut, but the market's starting to wake up to maybe, well, we're not getting it right now. So are we going to get it in June? Should we be looking out for it? All of these are starting to become the concerns. Funny how it's in plain sight, but suddenly it becomes the talking topic, which it wasn't a few weeks ago. And this is why the narrative is less important than the price action overall. But yields were up. That's been something that we've already seen the trade going on for. And it led to growth being okay, specifically high quality, high big cap growth. But the ones that broke out last week, the small caps and the Russell 2000, they were down the hardest for the session. It was certainly a breakout, so we'll have to look at it on the charts later on to see whether this is an opportunity, but that's what was occurring. Speaking of the Russell, let's have a look at the Russell 1000 growth versus value. Did you know that the growth's been doing all right, but the value's been doing pretty poorly? We're at a 1.4 ratio, suggesting that maybe value stocks and mid caps will continue to outperform like they have been for the last couple of weeks, the bigger cap markets. Now, this is possibly why value is now a little bit cheaper than some of the bigger growth stocks out there, and you'll notice it's at a 0.57 ratio. Is this the cheapest it's ever been? Absolutely not, but it has found base support purchasing in the past, which has led on to at least a cyclical small couple of months of outperformance from these particular markets. It may also make sense as well to where we are in the current cycle of a general presidential year. Let's take a look at Wall Street's S&P 500 forecast. So right now at the time of recording, we're well above where most of them are sitting. So are they going to revise their forecasts? Well, they better do so because at this stage we are trading a little bit too high. And as we know, what the economists forecast, although it's usually lagged off, will generally be what markets like to do. Now, this is a little bit of a pop chart in terms of the way it looks, but normally the S&P 500 rises with analysts' optimism, and it's quite closely correlated because they upgrade, then they start purchasing themselves. Now, it doesn't mean that's a lead indicator, but it should be going on with the markets itself. And we'll see in Q2 earnings coming up very soon whether they're going to be upgrading or downgrading. Because if they're downgrading, well, the markets may not like that. The CRB commodity index continues to improve. It just hit a new 52-week high, which is pretty sweet. And copper is entering into the biggest contango in over 2 decades. Now, a lot of people would not be aware of this, but this basically means that the short current version of copper, like everybody doesn't really want it right now, but the future, everybody does want it. That's when you get a contango effect. So it's expected that in 2025, copper is going to be doing pretty damn well. But right now, it's super contangoed. Now, could that be a weakness in the economy as we're seeing it right now compared to the future market? Absolutely. I wouldn't read too much into it, but I have seen this chart going around quite a lot right now. And we've seen contango in the past, specifically with the famous gold $40 barrel, which was pretty amazing. And that's why sometimes it's very important to look at your futures contracts. Look at the current contracts, also look at the 12-month, 18-month off contracts themselves. Goldman Sachs, as we've been mentioning, believe that there is less profit in these markets over the next coming months, and that's because we're a little bit overpriced to the current earnings. Now, most of that's got to do with AI, and you can see here that they're forecasting a 2 to 3% return over the next 6 months based on these multiple factors. That also lines in with what we're kind of seeing in general seasonal patterns. Now, we didn't see the March sell-off. We didn't obviously see any type of Feb March pullback at all. In fact, we're tracking 2012 and 1976 a lot more closely. But this is a period where we tend to go into a sideways market action. And as we've been kind of going through the stats and proving to this point, it makes a lot of sense. As I mentioned before, 2012 and 1976 are the most correlated markets to right now. Both of them started off very aggressively, had Q2s that were lackluster to say the least, and ended up having pretty decent years. Is that along with the stats? Yeah, it tends to be exactly how we usually see the markets. Now, if you know anything about your seasonality, you would know that April and May tend to be some of the best months, at least over the last decade for the markets. This isn't a surefire go buy the markets. We did see 2022 obviously offer one of the worst periods for April, but it's been 9 out of 10 in terms of wins for this month. So price action is still driving higher. But where the weakness might be is in semiconductors. Over the last 10 years, this semiconductor market went sideways to down over the month of April. And because that's become such a huge part of the markets right now, if they do fall, what's that going to do? Well, it's going to drag on the market from that action. And then if we see commodities and other smaller parts of the market start to do well percentage-wise, that will cause that sidewaysing, or what we call a pullback in time style market. Take a look here at everything that's going on in terms of the biggest releases this year, and you'll notice that it's going to be gasoline, coffee, cotton, crude, gold, Brent, all of these up the top. I tend to favor some of these ones at the moment. I like this one. I obviously like copper, silver, gold, Brent, and crude tend to be probably the two best in the current market action. And this is how they should perform if we do end up getting interest rate cuts. So if we're in stagflation, they'll probably perform pretty well. If we're in an interest rate cutting environment, guess what? They might even perform better. And that's because you can see here that the impacts of 100 basis point policy induced decline during a strongish market, during what we've been seeing so far, which is a strengthening market, at least based on the stats, that could be very bullish indeed. Let's now jump on over to the charts and have a look at what's been going on in the markets. And it was a day of the bears really winning out. The S&P 500 fell from the 5260 level, which is where it basically opened. As we mentioned in the last video, this is literally where the calls were. And then we fell down and we rallied back up. Now, was there an easy trade here? I would say not really. If we look at the smaller time frames, we go to something like a 5-minute chart, we can see how the actual market ended up trading. It was pretty much down through the session, a small spike that happened on here, and then it went down and it closed pretty much near its lows. So a small win for the bears, but I think the futures market tells us a little bit more about what's going on. And the bears have taken control, at least on the very, very short time frames. First up, as we mentioned, call resistance at 5260 and 5250 was kind of like the key level that we'd be trapped upon, and it continues to be this way. Huge amounts of puts at 5250, huge amounts of calls at 5275. So a trapped market might be what the doctor ordered in terms of the options at this stage. A movement down is going to expose 5200, 5207, movement under that 5176, a movement under that 5090. They're the key levels on the downside, and the big zones on their way up are going to be 5275 and 5300. We're still in a positive gamma environment, so that's very important to note. And if we do end up getting a change here, I could see it coming up to like 5260 and possibly a short being here over the next 24 hours, or even a drop into this level with a buy coming back through. They're the two main favored points that I would have on the smaller time frame charts. Let's take a look at the options together. Why is this? Well, you can see it as clear as day here. Have a look at this. This is wild how many calls are sitting at 5250, 5260 over the next 24 hours. And then we've also got puts sitting very closely just behind. A trap market indeed, at least from the options side. And it's pretty similar also on the day of the Wednesday trade. So Wednesday, we've got even more puts sitting here and just as many calls, which basically means that the 5250 strike is going to probably get an explosion on it. The markets are going to move towards that next level, which is going to be 5200 or 5,300, you would think. And if you were a betting person, you would say the bullish side is currently still in control. And that's just because, in general, positive gamma environment, the overall indicators are still performing pretty well. Now, if that happened and the bonds market started to drop off through the low, well, that would be a totally different situation. Obviously, bonds market matters, and if it falls through, it's going to be bad. Let's take a look at the sentiment indicators. Are we all the way at the top or the bottom? Well, according to a lot of them, we're kind of in between. We're not at 2021 levels yet. And as we've mentioned, this is still a buyer's market overall. Any corrections that we get at this point still look to be purchased up. And it looks like even if we go down to something like a 4,700, that's still going to be in corrective territory. So remember, the bull trends are usually pretty long lasting, and they're not quite at these extreme highs, which is something we'll bring up many, many times in the future, I'm sure, in terms of that overall indicator. We also know that the Twitter economic sentiment indicator is out now, and it's shown us to be relatively high. In fact, conducive with periods of 2021. And this is just a different read across the board. And it's kind of showing that, yeah, maybe we're getting a little bit too frothy and a bit too much FOMO in the markets. Goldman Sachs tends to agree. They think the market is pricing it in incorrectly. Sorry for the blurriness of this chart, but overall, they're believing a 25% chance of a 5% plus move in the month of April and May is pretty much due. US interest repayment scenarios. Would it be better for the Federal Reserve to possibly cut rates? Based on this chart, big time. These interest repayments are wild. Have a look at this. December 24, 1.6 trillion if we have projection assuming rates are stable. If we get 150 basis point Fed cut, it becomes a lot less bad. And in general, there is a lot of debt that needs to be serviced, and it's going to be very tough, you would think, from the government side to be continuing to do that. Lower interest rates would be quite beneficial for those repayments. What about breadth? Is breadth improving? Yes. And where is it showing us that we should be investing? Well, generally it's mid caps. I've obviously been discussing, and we all have together, the idea of metals, minerals, energy, gold recently, and I think they've been the way better place to be. But notice this, the mid caps across the board have been improving now substantially for a little while. Is the small caps coming up? Absolutely, they've also been improving, but the mid caps are kind of in full flow, whereas the small caps could be just beginning. Percentage of S&P 500 stocks within 5% highs, looking pretty damn good. You can also see the percentage of S&P 500 stocks within 10% of their highs is pretty damn amazing, and 2% of their highs is getting on the 4. So yeah, that's a little bit lower than it's been here. But in the other two metrics, very strong gains. And this is usually to do with pretty bullish markets. You can see here in the previous periods, while we're getting up there in those stats, there's sometimes a little bit more to run. So breadth-wise, still pretty nice. When we have a look here at consecutive numbers of days above the 200 moving average as well, the Qs just slid into their fifth longest streak that we can see here back in history, all the way going into the mid-2000s. And during those periods, what ended up occurring? Well, the markets went usually sideways for a little while, a pullback in time. We are overdue it, and it could be coming. S&P 500 quarterly performance when we have a 10% quarter. These are what tends to happen. Again, there are a few sideways market actions, also a couple of pretty bullish ones. And as we've mentioned, usually every 67 days we get a 5% correction. We're now well over 100 in terms of those charts. We'll blitz through these because we've talked about them a lot of times. We're in a bull market run in terms of secular bull market runs. We've already done the analysis to find multiple different correlations here. It's 1950, 1980 in the current run. Well, this is usually where we start to get pullbacks. And it doesn't just stop there. If you actually have a look at the correlations to do with the 74-42 pickups as well, this is where we tend to have a sidewaysing or a little bit of a pullback market. Too early to tell on the price action itself, but we will be watching for those key levels. Gold Trust. Well, I've been a big fan of gold stocks, and they have been doing very, very well. However, there were a couple of sweeps over the last 24 hours that are of note, and it's probably showing someone took a little bit of profit on some of the gold stocks. My guess is this is because US dollar has been blitzing up, and gold doesn't actually like high yields. So I think someone probably took a little bit of profit then over the last 24 hours on some of the gold trades. If you're in it for the longer haul like me, I think there's a little bit more to go on gold, but it may take quite a few months. iShares 20-year treasury bonds. Wow, there's been a lot of trades here. The reverse repo market, often considered a market that kind of sustains this. That's starting to drop off as well. So treasuries is going to be one that we need to watch. And reverse repo, just so you know, it's only one of the factors that really goes into the overall market liquidity. And I think a lot of people are making a big deal out of it. I don't think it has as much correlation. It's generally just used for that treasury side of things. So treasuries will be the one we want to be watching, and of course bonds in general. Measure of job openings has been turning negative, although the non-farm payrolls has been relatively strong. You can see here job openings is down across the board, and that's leading into us thinking that maybe we're going to get a bit of a weaker jobs number, but it's too early to tell again for that. Watch out this Friday. Brent CTAs are on a massive bull trigger. Take a look at this. Brent CTAs bulled through, new high now on everything to do with the oil markets across the board. Congrats, people that traded that one last week. Very well done. Awesome moves there. And the VIX, I thought I'd update this in terms of the main key levels that we want to be watching. 15 in particular is a big switcheroony in terms of the overall this week of what's going on. And watch out for those VIX expirations, because 15 to 16, if we close above there, it'll be fairly key. I thought I'd include this as well. It's the reverse repo market. You can see there's 74 participants, but 16 less in terms of overall participants in the reverse repo market. And we've moved down to the 441 billion side. So yeah, it's a pretty big deal, but it's not enough for us to go and get edge off it. VIX, volatility index, remains, as I said, stuck 15, 16. Set the alerts there just in case. S&P 500 central bank liquidity, we reported on it in the last day and it dropped off like a cliff. And then all of a sudden, it came back with a little bit of a vengeance. Now, during that period, reverse repos actually dropped. So it's interesting to see here that the central bank liquidity indicators, at least the way we track them, will do a special on them soon. We just ran out of time today. 52.40, all of a sudden it becomes semi-supportive over the last 24 hours. Too early to say anything on this. We will continue to say that is looking much weaker than the market across the board. This was the story. Yields, yields, yields. Every yield was up. And you can see here the 10-year is looking at that 4.35%. Make sure to set an alert for that. If yields go through this Friday, the market's not going to like it. Inflation plays are going to be big, and the VIX is going to jump, and you would also expect stocks to go down across the board. High yield junk bonds, well, they were down big time, and this often is considered risk on. So it's okay when it's sideways, and it still is technically in the sideways market structure, but you want risk on to be sideways or up in a nice growing market. If this goes through some of these key levels such as 76.59 and we see price action go through something like the daily 20 moving average, yeah, it's not going to be very good at all, and that's going to show that the bears are in control. We also had high yield index options in general jumping up across the board. You can see here we're about to make a new high on those, and this is a precursor often for the bears getting in control. So a few more bearish indicators. So let's go through a few of the indicators that are actually pointing towards potential worries right now. High yield bonds obviously jumping up, reverse repos getting absolutely drawn down, and of course the most important one, which is bonds in general, starting to drop across the board, specifically the risk on sentiment ones. Yeah, it's a little bit early to tell here still, bears, but you're looking for price action. Obviously, data, all of these collective concepts and confluence concepts, they're important, but you will need price action to verify anything. Consumer staples versus the discretionary sector. You'll notice here that discretionary has held itself versus staples, again showing the American consumer looks okay. And for really anyone that was on the long dollar train, you'd be very happy with yourself over the last 24 hours. An excellent breakout there, pointing towards 105.50. I think there's more to come here for the US dollar, and I expect drops to be met with bull demand, which I think will also put some pressure potentially on the gold trade. And although I still go with the gold trade to much, much higher levels long term, I do think the US dollar strengthening may at least hurt gold versus the USD. You see here the trend still remains up, so very, very strong. In general, gold's been doing really good. And I still think gold stocks are the best overall in terms of general risk reward. Silver markets, are they doing better? Silver markets also improving over the last couple of weeks. You can see here the daily also holding up. Silver markets looking to break through 25.80. If you do manage to get above this level, you can see here, I think it's going to be a fairly aggressive move for silver. So I would bring silver back onto the charts and start watching them. Gold stocks, there were a couple of transactions that went in around these highs, so we have to probably assume they're sells. Could they be accumulations? It's possible. I would kind of think like this would be a very big possibility. Mark out that $32 on gold stocks. If it comes back down to that level, I would expect buyers to be present around there from a technical zone. US oil, super huge breakout. Beautiful stuff here, guys. 88 a barrel next stop could be looking really strong. If you got into the trades last week, we talked about the most traded area. We talked about how it was now or never for the oil traders, and they came back big time. So to get through this level, really, really nice. Semiconductors versus SPY continues to be sideways. This is a great indication if you want to see whether there's weakness. And one of the indicators that I wanted to kind of bring up here was the 20 moving average. So are we using moving averages wrong? Some of you guys might be not using them the way that at least I like to do it. So a lot of people use moving average crosses. Now, I tend to find they're not very good. What instead you should be using moving averages for is dynamic support or resistance. And that means that if the markets come down, I have a kind of theory where I use the 1-2 ratio. If you have a bounce off it, it makes a new high, a secondary bounce off and it makes a new high. I call it the 1 and the 2. And that means that the 3rd, the 4th, the 5th, etc. would all be good. Another little tip here in dynamic or support resistance trading with moving averages is that you want to be looking at this candle as well. See how this candle's come down. You might think, wow, it's broken below. Well, it's all important on how it ends up closing. If that closed as a red candle, I would agree with you at break below. But instead what happened is it sold off due to some shock bit of news. It rallied through the whole session and ended green. So I don't actually call that a break to the downside. Now, you can disagree or agree with this, but I find it to be quite good to keep you into strong trends, and it's certainly worthwhile paying attention. So next time you put an indicator onto your charts, especially the moving averages, think about it as dynamic support and resistance, and it might help you out. Let's have a look here at the Wisdom Tree US mid-cap dividend funds, again increasing across the board. XLE, new all-time high, beautiful stuff here. Well, it's not all-time high, but new multi-year high here for the energy sector, so it's really improving. Metal sector also getting near that new multi-year high factory, and it's doing very, very nicely indeed. We continue to be bullish on those two sectors for the next coming months as we're in a higher yielding environment, at least for now. Did Tesla do okay over the last 24 hours? Not bad. Dropped off, found a big buyer, obviously ended up as a wick. I think day traders will be wanting to look at that high for potential momentum moves. 177 plus breakout could be kind of strong here for Tesla. So a nice pickup considering it was looking quite weak. Now it's had 4 days in a row though where it's opened and ended up selling by the end of the session. So yeah, the bears are technically in control of that overall in terms of the sideways, but I do like the wick and I do pay a lot of attention to wicks at key levels, as we mentioned in our last video. So go check that out as well. Handy tip around the gold analysis. Let's go to the Apple section here. Now, Apple looks pretty weak. I'm not loving this chart. If it gets above 178, nice. If you're a dollar cost averager, maybe you'll like it. Is it clear support level? Yes. But do remember, it's also a clear double top. So just watch Apple. I'm usually using that as more of a proxy trade versus a few other things. So at this stage, Apple is at an interesting zone, but still looks weak on the charts. Nvidia continues to go sideways, which is pretty normal. Another one that most people are trading here, or at least looking at, is SMCI, and it continues to be around that area where the bears are trying to push it down here, and the bulls would love to regain, I'm sure, 1,115-ish zone. If they do that, it'd be quite strong. Some huge wins over the last 24 hours. Awesome to see HSI doing so well. The Chinese market's really starting to step it up. This is a big close. I think momentum's coming back in this market. Spoke to a few people. A few people are starting to get a little bit hotter on it. We've been hot on it now for over a month together, and it's been doing really nicely. Here is the CQQQ, just to give you an idea. KWeb as well is doing an improvement. You can see it's kind of had those nice gap down bounce ups. So showing again with volume and a few other things that somebody's trying to trade at least these markets. Aussie 200, pretty strong, holding up. Same with the FTSE. That's because of the minerals, the metals, and the financials. And it's maybe moving towards 8K. US 2000 did sell off. So the weekly after the close was good, but we haven't had that incredible strength coming back in. Key level to be looking at, I think, this week will be around this 2080 zone to see where the buyers come back in. I don't really like this level too much. So I could see like this potentially being a buy zone. And then after that, it'll be that 2020, 2040 zone. So for now, looking for a little bit further down on the US 2K before purchases may come back in to support it. Qs are dull. We know what we say. We don't really like shorting dull markets. If you do, options would be your main friend. And it's it's driving around in a circular. Long leg doji, nothing much going on in the Qs or the NASDAQ trade at this point. Watch the US 500, I think, a little bit more closely. Now let's move over to Bitcoin. So this is not the best for the Bitcoin traders. We've been talking about how the bulls have been in control. We obviously saw this market here, which went chop. Now we've broken to the downside. It's possible that Bitcoin could replenish and then find a huge wick here. If it does, do not go against that. It's going to be quite bullish, and I'd expect it to actually fly to a new high. But this is not great. Now, if it comes back down to that 63K zone, I'm not confident that that's actually a great buy. And it could be going through 60 and then moving back down to that 51K level. So this is the ultimate, or at least one of the better, way better buys. And remember what we said about bonds before, risk on, risk off. If bonds continue to drop, especially high yield bonds, that's signaling risk off across the markets. And in some ways, even the reverse repo markets also in some ways signaling that maybe we've got a little bit of random stuff going on here. So some instability coming in, some narratives coming in. Ultimately, as we always know, guys, follow the price action, follow those trends, and stick with your plans. Whatever your plan is, stick with it. Practice the risk management the best way you can, and that will usually serve you well. In terms of the information, there's plenty coming out this week, but really it's about non-farm payrolls or the jobs numbers for the US, 8:30 a.m. New York time on Friday. Thanks so much for watching. Subscribe, smash that like button if you enjoyed today's content. We'll see you in the next one. Bye for now.